Welcome back to Alternative Angles, a Fidelity podcast series where we hear from fund managers, analysts, and traders who make investment decisions in complex alternative strategies. I'm Steve Rosen, a member of the High Income and Alternatives Division, and I'm your host. If you've ever watched the video of the 1940 collapse of the old Tacoma Narrows Bridge, which you can readily find with an internet search, then you've seen how a structure presumed sturdy and durable can swing and then break. Had the bridge been built differently, with appropriate dampers and shock absorbers, its ruinous sway would likely have been prevented. Likewise, by strategically assembling a portfolio of financial assets with diversifying counterbalance, an investor would be better protected and more likely to withstand market drawdowns. So, just as a damping mechanism would have come in handy for the bridge, an investment portfolio appropriately built with an options-based overlay, the topic of today's episode, is a method to create a more stable return profile. To explain this approach, I spoke with Eric Granat, an equity derivatives analyst and the portfolio manager of several of Fidelity's options-based strategies. Eric's a highly experienced expert who spent more than 20 years trading, analyzing, and investing in options, and he can clearly articulate in plain language how they work and their use cases for investors. I think you'll find our discussion full of valuable information and insight. And now, my conversation with Eric Granat. Eric, thanks for joining me today on Alternative Angles.
Nice to speak with you, Steve. Thanks for having me.
Sure. Before we get into the nitty-gritty of options and some options-based investing strategies, why don't you step back and tell us about your career and how it led you to managing portfolios here at Fidelity?
Oh, sure. Yeah, thanks for the question. Well, I guess my story goes back to 1997. I graduated undergraduate college with a degree in computer science. So I was, for the first 5 years of my career, a C++, SQL type developer. I landed at Fidelity and also spent time with a large life insurer in the greater Boston area. And during that time, I was writing financial models, and I eventually ended up writing Black-Scholes calculations and derivatives-related calculations for a trading desk. And so some point around 2003, I realized, geez, with this programming background and the data-centric nature of derivatives, futures, and options particularly, it seemed as though I could get at the data just a little bit faster, a little bit more efficiently than some of my peers. So that encouraged me to pursue a trading opportunity. So I'd say from 2003 to 2009, I was a dedicated trader, primarily of futures and options, but also in single stock and ETFs. That trading role eventually morphed to portfolio management in 2009. And in 2012, I joined Fidelity in my current role as a portfolio manager and derivatives analyst. And I focus on, I'm an equity derivatives guy through and through. So futures, equity total return swaps, and of course, my favorite, options. So that's been my focus for the last, 13 years here at Fidelity. And it's been a lot of fun so far.
Great. Well, thanks for taking us through your career. You've got a great background. I can relate. I was also an engineer, a systems engineer, but I was back then programming in Fortran, so a little bit before the C++. Nonetheless, back to the topic today. Let's level set as we kind of get to the brass tacks of options. And so tell us, what are put options? What are call options? Give us some flavor for their attributes and their benefits and their risks.
Yeah, of course. That's a great place to start. So options are, first of all, I think incredibly popular. I think you and I would have a different conversation on this topic if we were maybe speaking before COVID. But once COVID hit, the use of options by retail investors and institutional investors alike really exploded. But for those that aren't as familiar, options are publicly traded securities. They trade on a listed exchange just like a stock. And we go ahead and trade them on a daily basis as if you were trading shares of an ETF or a stock. It's important to note that there are two types of options. There are call options and there are put options. And at the very highest level, I think it's safe to say if one were to obtain long exposure to a call option, they're going to gain long exposure to an underlying equity index or ETF. Inversely, if one were to gain long exposure to a put option, they're going to go ahead and receive negative exposure and or hedge, if you will, a way to ensure long exposure to an underlying equity index or ETF. Options are, I think this is important to maybe talk about a bit. Options are somewhat unique in that they're non-perpetual assets. And, an example of a perpetual asset would be something like an equity, right? We buy it once, we hold it for a very long time, and you're good, right? If you bought the allocation that you want in the beginning, you can hang on to that and collect dividends and, own it for years. Options, like futures, are very different. These are securities, or I should say, security types that have a finite life. Typically, I think it's most common to trade options that are either on a monthly or quarterly cadence. And so if you think, okay, I'm going to buy an option position that's a month out or maybe 3 months out into the future, at some point that option is going to expire, and it'll expire either in or out of the money. It's important for investors to realize that these positions have to be continually maintained or updated. And in options trading parlance, that would be rolled. And that attribute, while it introduces some management and some ongoing care and feeding for the option position, it introduces a tremendous amount of flexibility for the manager to decide how we want to trade the position. And it gives us unbelievable granularity in how we want to sculpt either an option position for risk management or an option position for income generation.
Okay, so you just mentioned insurance or protection and income generation and adding options to a portfolio to achieve those, but couldn't an investor attempt to do that by owning a traditional 60-40 mix of stocks and bonds on say the expectation that stock and bond returns are inversely correlated, and they presumably could build that on their own. They could invest in a balanced fund, for example, which is very reasonable. Tell us, why are these options-based strategies worth considering as an alternative, say, to the traditional 60-40 portfolio mix?
Yeah, that's a great question, Steve. And I think for the investors out there that remember 2022, which was a year where the S&P was down roughly between 18 and 19%, it was a year that a lot of these risk managed strategies, the most popular risk managed strategies, didn't do that well. And I'm thinking specifically of 60-40 because you mentioned it, right? So 60% equity, 40% fixed income mix. I'm also thinking of min-vol or low volatility equity allocations. Here's my opinion on the topic. There's no one type of drawdown. There's no silver bullet. And I do think that, just like most things in investing, a diversified approach works. So going back to your reference to a 60-40 allocation, uh, incredibly popular. I have a hunch all of us out there have some hint of a 60-40 or some allocation to a 60-40 portfolio somewhere in our asset mix. And it makes a lot of sense, right? The 60% allocation to equities is thought to be the primary driver of capital appreciation in that portfolio. The 40% allocation to fixed income or credit is thought to be the hedge, right? And that's born out of the expectation that when equity markets go down, there should be a flight to safety, and that should drive valuations of bonds a little bit higher. Therefore, they have a nice inverse correlation, and at times they certainly do. What we're continually reminded of, and what the historic data suggests, is that inverse correlation isn't as consistent as we like to believe it is or hope that it is. I think it presents a strong argument for an allocation to a hedged equity strategy or options-based strategies in general that deploy an option strategy at an index level that has correlation to the underlying equity. And one final point on that I'd like to make. So I did mention, again, min-vol or low-vol strategies. Again, strategies I think are great, but the expectation there is, again, by owning a basket of lower volatility stocks, where the investor would experience a lower vol profile over the course of a market cycle. And I think that is true. However, in the most extreme volatile markets, and you can think, of course, of 2020 or Volmageddon there in 2019, back to the global financial crisis, we know that in extreme environments, correlations across the board, across the equity board, jump, right? So even if you're in the lowest vol allocation of equities, those strategies are going to suffer meaningful drawdowns in those periods as well. So Yeah, it's interesting to think about how an options-based strategy can fit into these more traditional tools for risk management in a portfolio.
With regard to risk management and the way you pursue it, maybe you could talk to us about how your strategies then combine exposure to the stock market with the contractual defense against volatility and losses, or with income. What are the building blocks that you use to get the outcome that one might seek?
In some ways, that speaks to the strength of working for, a firm like Fidelity. So we have deep expertise across the board, right? So I like to think we have the best of breed equity and fixed income, high yield. I like to believe I'm part of a best of breed derivatives team. And so we're able to combine these different components and build differentiated products. So I work very closely, again, as an options or derivative specialist. I partner with long equity managers. So in the case of our suite of mutual funds and ETFs, I partner with our quantitative research and investment teams. They construct portfolios with exceptionally tight risk parameters, very, very tight sector bets, very low tracking error. And so I'm working in an overlay fashion, if you will. So once we establish the equity portfolio, the equity exposure that we'd like to incorporate in our fund, we then pair with that internal manager, and the derivatives team, my side of things, will begin to construct the best hedging mechanism and or the best option strategy to suit the specific objective of the fund. And I think it's important to note, anytime you have two teams working together for a shared goal and you introduce options, it can't be overstated that we are introducing cash flows, collateral considerations. Obviously there's performance considerations, and so a close working partnership is essential. And I'm happy to say that's what we've achieved and maintain here. Very, very intraday close collaboration between our equity teams and the team that manages the derivatives exposures.
You mentioned a little while ago that you're using index options, so you're not hedging each individual holding in the long equity portfolio. In your view, what are the benefits of using index options as opposed to hedging each individual position?
So I think there's probably two ways we can slice that one up. From the investor's perspective, I think there's two arguments for index-based options: liquidity and transparency. So we can, let's talk about liquidity. We can have the best hedge on the planet. If we get an extreme vol event and we can't trade it and trade it very, very efficiently, it doesn't do us any good. So we focus a lot of our time evaluating what are the most efficient securities, what are the most liquid securities, particularly in times of crisis. That's what we want to incorporate in our strategy. So S&P 500 index options, check that box. Probably one of the deepest pools of liquidity out there in listed markets, period. On the topic of transparency, so we think investors should be able to see exactly what's in our portfolio, whether they're using Yahoo or, a Fidelity app or some competitor's app. We want them to be able to see what we have in the portfolio. There's no secrets here. And so we think that that's very, very important. We like listed options because they give us that transparency, they give us that liquidity. And by the way, they don't incorporate counterparty risk. So these are exchange listed options and they're centrally cleared. Important to note too, we care a lot about granularity. I want to construct the most tactical, well-defined hedges that we possibly can. And so again, thinking about the innovation that has occurred in the last 5 to 10 years, particularly the last 5 years, at the index level for these S&P 500 index options, we now have daily expiries. We have tremendous strike price granularity. These securities, we have expiries every single day of the month, and we have expiries out at least 14 months into the future. So not only can we select specifically what strike price we want to trade, we can also select between a wide array of expiry dates. That helps us construct a hedge that is resilient, robust, and very, very tradable. So that's how I position it from an investor perspective. I'd like to give a little bit of detail from my perspective, right? As one of the people that are managing these strategies on a day-to-day basis. Index options give us tremendous economies of scale. And what I mean by that is we can trade one index option, or in the case of our portfolios, generally we hold less than, we'll call it eight options. But I can hold 8 options and hedge an equity portfolio that might include several hundred names. And so if I were to operate at a single stock level, I would have to trade literally 300 to 400 different positions. The
Right.
ability to do that with just 4 or 5 is fantastic, right? It dramatically lessens the burden on our operations, our collateral management, our portfolio management, reduce trading commissions, a tremendous amount of things to think about. So it's worth highlighting, I think, both sides of the benefit of index options.
Yeah, it sounds like there's notwithstanding the fact that the index options make things easier, smoother, still a pretty dynamic market. Sounds like it's evolving. You had mentioned growth that took place during the pandemic and a lot of increased interest in options-based strategies as well. So as a practitioner, maybe talk to us a little bit more about some of these new developments in the space.
Yeah, of course. New developments are important to us. We want to do our best to incorporate new securities. They're going to allow us to, again, create more granular positions as they evolve. And I'm going to give you one important example. So in August of 2020, the Chicago Board Options Exchange, this is the primary exchange for the S&P 500 index options, they started to list options with expiry dates that are out 9 months, 10 months, and 11 months into the future. So with that development, it gave us and other asset managers the ability to say, okay, this is very interesting. Now, not only can I trade options that are closer dated, say 1 month, 2 month, 3 months expiries, I can now go further out in the term structure or further out into the future. So now I can create, in what we seek to do at all times, a very diversified holding of protective instruments, right? The best hedges, in my opinion, protect equity allocations from a broad spectrum of risks. And what's the best way to do that? There's no one type of drawdown event. There's no one type of vol event. We just don't know what's coming around the corner. And so to react to that position for that, I want to hold the most robust hedge I can. And for me, that means in our hedging products or the hedged ETFs, we're going to hold at least 6 different expiration dates with 6 different strike prices. So we're going to guard our equity allocations, again, from that broad spectrum of risks that I don't think we could have done as efficiently 5 years ago as we can do today. And that's thanks to the continued evolution of the options market in the listed space.
So does that differentiate your strategy, or are others doing it? And I guess staying with differentiation, are there other elements of the way you employ your strategies that differentiate them in the marketplace?
Boy, there's a lot of meat on that bone. We do seek to do it a little bit differently than most of our competitors. And I'm going to give you a couple of highlights on that. The first is that, we believe wholeheartedly that option positions should be actively managed. So, I don't believe in buying a 3-month put and sitting on it till expiration and then going ahead and rolling another 3-month put. Options are, again, are not perpetual investments, right? They have to be rolled. And the other interesting thing about options is there's an embedded multiplier or leverage within each option. And that gives us the ability to spend a little bit of cash to purchase, say, a protective put. And if we have an extreme drawdown, the value of that put is going to increase exponentially. And that's because of the embedded leverage or multiplier in these options. And so when you think about that, I firmly believe that the best deployment of a hedging strategy is one that enforces a buy low discipline. At the core of everything we do, we're equity investors. And so we believe that if we have a put that is appreciated tremendously, let's harvest some of those gains and let's buy stocks at a much more appropriate level. So again, this goes back to working in concert with our equity team. When we do have severe drawdown events in our strategy, you will see our team, we will take gains and we will buy stocks at more attractive levels. And we think that not only keeps the portfolio in concert with what's happening with the market, but it also reflects our view that, there's 2 sides to every drawdown event, right? We have the initial spike in volatility and we have the decline in asset prices. But at some point, typically, there's a bottoming out period, and then assets start to rebound. We can do investors a whole lot of good if we are buying more securities at the market lows. We're going to compound at a better rate as the market recovers. So our strategies seek to reflect that mindset.
A minute ago, you mentioned leverage with respect to the index options, and that could be a yellow flag. So tell us how that works, and just remind us as to what goes into that, and are there risks, or are we covered? I assume it's because the exposure that you're getting by, say, through the puts or the calls is large relative to the price you pay. But I'd like you to flesh that out for us.
Yeah, sure. So, yep, leverage is embedded in every option that we trade out there, whether it's a single stock, an ETF-based option, an index-based option. Leverage is one of the most beneficial attributes of these securities. So, if I could, I'd like to reference Fidelity Hedged Equity. This is a strategy where we're combining actively managed exposure to U.S. large cap equities with a actively managed long protective put strategy. In that strategy, as we roll our puts, at least on a monthly basis, we know that we're going to spend roughly between 40 and 60 basis points a month to hedge the portfolio. And so you think, okay, well, it's 40 to 60 bips a month, or roughly half of 1% in cost per month to maintain this insurance policy, if you will, on the equity allocation. Boy, that's a pretty significant cost. Well, true, it is significant, and it's something that we seek to manage. However, when you think of the benefit that 50 or 60, 40 to 60 basis point cost could provide, again, we know that if we believe, and history suggests, if the market were to decline by 20 or 30%, have a real 2008 type event, those puts, which originally cost us 40 to 60 bips, they're going to return hundreds, if not, 1,000 basis points. And so it's that leverage that allows us to, I think, in a cost efficient manner, hedge a large amount of notional value for a relatively small upfront investment. So your question is a good one. Leverage is something that needs to be managed. And I would say when you're hedging, that comes down to the amount of portfolio notional that you're exposing or that you're hedging. That's how we track it. We track our option positions not only by their net dollars delta, but also the notional exposure relative to our equity holding. And if we're talking about a strategy that's going to sell calls or sell puts, of course, that comes right back to the notional exposure, right? I think the most widely agreed upon way to sell options responsibly would be to do it in a covered fashion, meaning we never have more than the notional value of the underlying equity represented, or AKA covered, by the short option position.
So, you mentioned some of your strategies there. You can incorporate puts, you can incorporate calls, you could combine them. So now you did talk a bit about your put strategy, which is going to be defensive, right? Because you're going to have a long equity portfolio and then buy put options to protect the downside. Is there anything else you want to add about its construction or the protections or the benefits?
I think, as I mentioned, right, there's no one type of drawdown out there. And I think it's also fair to say there's no one type of investor risk profile. We're all a little bit different. We're all different ages. We all have different risk appetites. And so our options-based platform consists of three strategies. I mentioned Fidelity Hedged Equity. That is a diversified long put allocation that complements an actively managed U.S. large cap equity exposure. That strategy, by the way, I think of it in my mind as a tail hedging strategy. We're buying puts that are out of the money, and we're paying an explicit cost for them. And what that distills down to is downside mitigation, particularly when the market is down, let's say, more than 5%. So I'm thinking of vol events, right? If you think in terms of VIX, or again, in market percentage declines, if we see a VIX index north of 30, or if we see the market starting to drop by 4 or 5% a day for maybe a couple of days in a row, that's unnerving to investors. That's when you want your hedge to kick in, because I think that's when investors start to make decisions that are more emotional and and less driven by financial reasons. So Fidelity Hedged Equity seeks to, dampen the damaging impacts of drawdowns and to also make the duration of drawdowns shorter. Oh, by the way, because we are not selling call options, we're not introducing upside opportunity risk in the portfolio. We get to root for the portfolio to rally with the market. So again, just thinking of 2024, S&P was up, I think it was up exactly 25% or 24 and 24 and a half, an amazing year. Those are the markets that we love. As an equity investor, we want to create a portfolio that gets to celebrate those exceptionally strong years right along with the market. So hedged equity, again, is, I think, very, very defensive in the left tail, but also because we're not selling call options, we're not introducing any upside cap, we get to celebrate the right tail too. So I think that that's a unique offering to the market. The other two strategies I just want to hit on real quick. They incorporate all of the DNA that we've been talking about today. Okay, diversified positioning, active management, and the day-to-day partnership with a very close equity team. The second strategy we have is an income-based strategy. Call selling strategies have been deployed successfully in a mutual fund format going back to the late 70s. So this is a well-known, tried and true way to generate elevated levels of income. And we're doing it not by going out on the credit curve, not by taking huge concentrated bets in particular equity sectors. We're doing it by monetizing volatility by selling calls. And so this is a strategy that, working on the same equity exposure, we're going to sell weekly call options. And this was going to reduce volatility by about 20% on an annualized basis. And it's going to provide income-focused investors with annual yield of between 6 and 8%. It's currently running about 7 and 7.2. So Steve, the third product we have is for investors that say, okay, I want a very smooth ride. I'm willing to give up a little bit of upside, and I really want to defend myself against not only tail risks, not only when the market's down 8 or 10% or more, but what happens when it's down 3% or it just grinds sort of sideways, maybe down 5% for the year? I want a product for that market. And so our third product, dynamic buffered equity, is geared to those investors in an exceptionally low volatility profile. Again, because we have the benefit of a short call option and also the long puts, compressing the vol.
Yeah, it seems like that's kind of the key, right? That your products allow people to perhaps have the peace of mind to stay with it and stay invested with some protection, and or income. Now, what about risks of the strategies? Is there anything that comes to mind there?
Well, so yeah, there's risk with everything. Obviously, we do have equity risk in the portfolio. Let's be clear, we do not have perfect hedges. Nobody does. Our products, we do seek to hedge in our hedging solutions, which are dynamic buffered and hedged equity, the vast majority of downside risk. But it's important to note that, yeah, of course, we're long equities and there will be some potential for downside exposure. I think that with every options-based strategy, because again, these aren't perpetual assets, because we have to have a rolling mechanism, there is implementation risk. I like to believe that we've reduced it relative to a lot of our peers. So again, an actively managed approach and working in close concert with our equity teams certainly helps that. And our products are available in ETFs, and that's an interesting environment. We have investors that can come and go every single day. And so one of the hidden risks of this space that I believe that we've addressed is that we believe at our core that investors, if you buy our fund on day 1 of the month, day 14, day 39 of the quarter, whatever it may be, all of our investors deserve as close to equivalent risk attributes as any other investor. And so what I'm leading to is that it's our belief that our competitors that are passively managed strategies that, again, the puts or the calls might be rolled passively on a monthly or even a quarterly basis. I think that there's a tremendous risk for investors that buy the strategy either in the middle of the month or maybe, again, the 45th day of the quarter for a quarterly rolled strategy. They're not going to get equivalent attributes or the attributes that are oftentimes marketed or associated with the strategy. We work very hard, and a large part of our construction and our day-to-day management is focused on the fact that we know that people are going to come and go every day. Hopefully more are coming in than leaving, but nonetheless, people are going to come and go every day, and we have to do everything we can to keep our options in sync with the market so that they're going to get the risk attributes that we discuss and that are expected from the strategy. So when I think about risk, it's not market risk. It's not risk specific to the instruments. I see risk and I see opportunity in the way these strategies are developed and deployed. And that's what we think might separate us with our strategies.
Well, it sounds like you've really been very thoughtful in the construction of your strategies. And I want to thank you for participating today on Alternative Angles. This has been a great conversation. I've really enjoyed it. Thanks, Eric.
Thanks so much, Steve. Thanks for your time.
This podcast is intended for institutional investor and investment professional use only. Unless otherwise expressly disclosed to you in writing, the information provided in this material is for educational purposes only. Any viewpoints expressed by Fidelity are not intended to be used as a primary basis for your investment decisions and are based on facts and circumstances at the point in time they are made and are not particular to you. Accordingly, nothing in this material constitutes impartial investment advice or advice in a fiduciary capacity, as defined or under the Employee Retirement Income Security Act of 1974 or the Internal Revenue Code of 1986, both as amended. Before making any investment decisions, you should take into account all of the particular facts and circumstances of your or your client's individual situation and reach out to an investment professional if applicable. Fidelity and its representatives may have a conflict of interest in the products or services mentioned in these materials because they have a financial interest in them and receive compensation directly or indirectly in connection with the management, distribution, and / or servicing of these products or services, including Fidelity funds, certain third-party funds and products, and certain investment services. Alternative investments are investment products other than the traditional investments of stocks, bond, mutual funds, or ETFs. Examples of alternative investments are limited partnerships, limited liability companies, hedge funds, private equity, private debt, commodities, real estate, and promissory notes. Some of the risks associated with alternative investments may be relatively illiquid. It may be difficult to determine the current market value of the asset. There may be limited historical risk and return data. A high degree of investment analysis may be required before buying. Costs of purchase and sale may be relatively high. Views expressed are as of March 2025 and may change based on market and other conditions. Unless otherwise noted, the opinions provided are those of the speakers and not necessarily those of Fidelity Investments or its affiliates. Fidelity does not assume any duty to update any of the information. S&P 500 Index is a market capitalization-weighted index of 500 common stocks chosen for market size, liquidity, and industry group representation to represent U.S. equity performance. Some of this information is forward-looking and is subject to change. Past performance is no guarantee of future results. Investment results cannot be predicted or projected. Information provided herein is for informational purposes only and is not a recommendation or an offer or solicitation to buy or sell any security or for any investment advisory service. Fidelity Investments provides investment products through Fidelity Distributors Company LLC and clearing, custody, or other brokerage services through National Financial Services LLC or Fidelity Brokerage Services LLC, members NYSE, SIPC. Copyright 2025 FMR LLC. All rights reserved. 1,193,235.10